Banking activities as controls. Banks offer certain protections for your cash as internal controls. So, for example, use of a bank account is a more secure place for your cash than in a safe at the office. Signature cards are used so that the bank knows who's signing a check, whose signature is authorized for that. Deposit tickets provide support for deposits to your account. Checks provide authorization for payments from your account. Electronic funds transfers, those are like electronic transfers, so like an ACH or a wire transfer. That is a more secure way of transferring cash from one party to another. Then bank statements, they are essentially a list of every transaction that has gone through the bank account. And this allows customers to reconcile their accounts. So making sure that everything that is recorded on the bank statement has also been recorded in the accounting records. And then that will help detect any unusual or unauthorized activity. So a bank account is used to deposit money. So you can see here, this is a deposit ticket. So people authorized to write checks must sign a signature card, which the bank uses to verify signatures. And then each bank deposit has a deposit ticket that goes along with it. So you list currency, coins, and checks that are being deposited along with those amounts. So you take this to the bank, give it to them with your deposit, and then they give you a receipt as proof of your deposit. This is a check. You've probably seen a check before, or you've seen your parents write a check, but basically it is what allows a company to complete this document, send it to the recipient, whoever they're paying, and then the bank transfers or withdraws that money and puts it into the other company's account. So to withdraw money, the depositor, that's your company, can use a check, which is a document telling the bank to pay a specified amount to a designated recipient. A check involves three parties: a maker, who makes out the check and signs it, that's your company if you're paying someone; a payee, who is the recipient; and a bank, who is also called a payer, on which the check is drawn. The bank provides the depositor the checks. So you can see here, this is one type of check. It has, you can see where it's made out. You can see the maker's information. So that's the company name, address. You can see the payee, who they're paying the check to. They have that filled out. And the payer, that's the bank. So make sure you know the difference between the maker, the payer, and the payee. Then at the bottom, under the dotted line, that is an optional portion that can be sent along with the check. It's called the remittance advice, and that's basically information about where to apply the payment. You can also put something similar on the memo line of the check. So checks aren't used as commonly as they used to be because now we can transfer funds electronically. So an EFT, or electronic funds transfer, is the electronic transfer of cash from one party to another. Companies are increasingly using EFT because of its convenience, low cost, and it's a little more secure than a check. So most payroll, rent, utilities, insurance, all of those types of things, those types of expenses are usually paid by EFT now. So then the bank statement, or your online banking, lists the cash withdrawals by EFT with the checks and other deductions. Cash receipts by EFT are listed with deposits and other additions. So if you initiate an EFT, or electronic funds transfer, that means you're transferring money to someone else. The same can be done on the flip side. So another company can send an EFT to your company, and in that case, that would be considered a deposit. The bank statement. Usually once a month, at the end of the month, potentially, the bank sends a bank statement showing the account activity. So before we had online banking, banks actually mailed bank statements to their customers. So now we can go online, see transactions, things like that. But still, we need an actual bank statement. It's just now we can usually download it off our banking website. So different banks use different formats for their bank statements, but all of them will include at least the following: the beginning of the period account balance. So, for instance, the beginning of the month bank balance, checks and other decreases to the account, deposits and other increases to the account, and then that will give you, once you add and subtract those, the end of period account balance. So you can see an example of a bank statement here. You can see part A that summarizes changes in the account. So the total of the checks and increases to the account, and then the total deposits and credits. Then part B shows checks paid, how much they were for, the check number. And then part C shows any deposits and other increases in the bank account. So along with the bank statement, a few other items to discuss. Let's see. I think I've already covered all of this. I'll explain this really briefly. So, we've learned about credits and debits. And I told you that has nothing to do with a credit card, debit card, anything like that. Forget anything you've ever thought about in terms of credit card, debit card. Part of that is still true because a credit card doesn't have anything to do with your actual bank. So what I want to explain really briefly are the bottom two bullet points. So you have to think about this from the bank's perspective to understand increases and decreases from the bank, from their perspective. So the company's checking account balance for the bank is a liability because you deposit that money as a customer, as a company, you deposit that into the bank account. The reason that it's a liability for the bank is that it will owe you that money back whenever you go to the ATM to withdraw something, whenever you take money out of the account, whenever you transfer money from that account to another company. So that's why it's on the books as a liability. So on the bank's records, the company's account has a credit balance. So because the bank statement is prepared from the bank's point of view, a credit memo entry, so anything showing a credit on the bank statement, is an increase to the company's account. So from the bank's perspective, that would be a credit. So if you look at it from the opposite way, a debit from the bank's perspective would be a decrease in the account. So when you look at the bank statement, anything that has credit beside it, that will be an increase in the bank account. And anytime you see a debit entry on the bank statement, that will be a decrease. So these are a couple examples of what would be credits and what would be debits. So this doesn't have to do with journal entries right here. This has to do with, from the bank's perspective, looking at a bank statement, what are going to be credit entries and what are going to be debit entries, just when you're looking at your bank account statement. So you'll see credit for things like electronic funds transfers that are coming to your bank account, collections of note receivables on behalf of the company that the bank collects from other customers, proceeds from a loan made to the company by the bank, interest earned on the bank account itself, and then potentially any correction if there are bank errors. So what would show as debits on the bank statement would be any checks, any withdrawals, any EFT transfers initiated by the company to other outside companies, bank charges, and then any customer checks returned for non-sufficient funds. So to explain that briefly, if a customer writes you a check, you go deposit that check in the bank. Well, if that ends up being a bad check, if they don't actually have the money in their bank account to cover that check, well, then you have to subtract that amount back out from your bank account because you didn't actually get paid for that because it was a bad check. All right, and so these are just some kind of codes that you might see on a bank statement. So EC would be an error correction to correct a bank error. NSF stands for non-sufficient funds check or a bad check. SC would be a service charge or a bank charge. ACH stands for automated clearinghouse, and that is an electronic funds transfer. And then any other miscellaneous items. So that might be the bank collecting payments for you from another person and adding that amount to your bank account. It could be if the bank loans you money and just puts it over into your account. So there are a few other miscellaneous things like that. So now that we've explained that, we will go into how the bank statement can be used as an internal control. So the bank balance shown by a bank statement is usually different from the company's cash balance on the books. So if you think about this for just a second in terms of your personal life, your personal account. So if you go online, look at your online banking in your bank app. So not always are you going to see everything, the full picture, because if you go swipe your card somewhere, it might not hit your bank account immediately. And if it does, it might only be pending. So you're not seeing the full picture of your financial activity. So when you swipe your debit card, sometimes it doesn't hit your bank immediately. You don't see that, but you know in your mind, you have to go ahead and subtract that out of what your bank balance was. Otherwise, you might, if you forget about that, or if you don't factor that in and you go swipe your card somewhere else, it might be declined, or you might end up withdrawing or overdrawing. So now thinking about it from a company's perspective, some of the difference between the company's balance on the books, what they've recorded, and what the bank says they have may arise because of the following reasons. First of all, there might be a delay by either the company or the bank in recording transactions. The bank has debited or credited the company's account for transactions that the company doesn't know about yet until they get their bank statement and see, a certain charge for a bank fee or something along those lines. And then because we are human, there can also be errors, and that can cause a difference in the account amounts. So the company has to do a bank reconciliation. Essentially, what a bank reconciliation does is adjust the bank account balance and adjust the book balance to get them to a reconciled amount. So you're not trying to match your accounting records to what the bank statement says. That is not it. So just go ahead and know that so you don't get confused. So bank reconciliation is a report that verifies the accuracy of both the company's records, the books, and the bank's records. The bank reconciliation explains any of those differences, and essentially it is a control over cash. So the objective of the bank reconciliation is to determine an adjusted balance. The adjusted book balance should match the adjusted bank balance. Like I said, you are not trying to get the book balance to equal what's on the bank statement. you are looking for an adjusted balance. And once you do that, you will have the adjusted bank balance, the adjusted book balance, and those will match. So this is how you do it. And we'll go over some problems where you'll see it, but I'm just going to give you a little background information first. So essentially, you're going to have two columns. On the left side, you're going to start with the bank information. So you're going to start with the ending bank balance. To that, you will add any deposits that the company has made that just haven't hit the bank yet. So for example, if it is September 30th and the bank or the company goes to deposit all of their daily sales transactions, all of the money that they've gotten on September 30th. So they go drop that in the night deposit box at the bank. Well, if it's September 30th and they're already printing the bank statements, well, that deposit is not going to be processed until the next day, and therefore it won't already be factored into the bank balance at the end of September. So we need to adjust the bank balance to account for that. So you would take the starting point for this would be you take the ending bank balance shown on the bank statement. You'll add in any deposits that have not hit the bank yet, but that you've already made. They just haven't been processed and added to the bank account yet. So you add those in. We call those deposits in transit. Then you would subtract out the amounts of any checks that haven't cleared yet. So in both of these instances, the deposits in transit and the outstanding checks, these are things that haven't hit the bank account yet, but the company has already recorded on their books. So if you're adjusting the bank balance, you need to add in any deposits that have been made that haven't hit the bank yet, and subtract out any checks that have been written that haven't cleared the bank yet. And what that's going to do is give you your adjusted bank balance. Then on the right-hand column, you will do the book balance adjustments. So you'll start with the ending book balance on the company's records. So cash, whatever cash in the bank is on your books, you will start with that amount. Then you look at the bank statement and you see any additions or subtractions that have not been accounted for on the books yet because the company didn't even know about these things or know these amounts until they got the bank statement. So you'll start with the ending book balance. You'll add any increases in the bank account and subtract out any decreases in the bank account that have not already been recorded on the books. So some of the things that you would add would be any interest earned on the account. You would also add anything that the bank has collected on your behalf that you haven't already recorded in your books yet because you might not know about these things. So certain electronic transfers, if the bank collects some notes receivable on your behalf, you add in all of that kind of stuff, all of the increases in the bank balance, and then you would subtract out any of the debits on your bank statement that haven't already been recorded on the books. So you'd subtract out bank fees, you'd subtract out non-sufficient funds checks. Remember, those are bad checks. And then once you do that, that will give you your adjusted book balance. You want your adjusted bank balance and your adjusted book balance to match. That's the point of the reconciliation. So here's an example of what your bank reconciliation would look like. So notice I mentioned on the left-hand column, you start with the bank statement balance. You add in any deposits in transit. You subtract out any outstanding checks, and that's going to give you the adjusted bank balance. So then on the right-hand column, you start with your ending book balance. So at the end of the month, this one is October 31st, whatever on the books you have recorded as the ending balance, You start with that. Then you add anything that you see on the bank statement that increases your account amount that you have not already recorded on the books. So here, just as an example, it looks like the bank collected some loan proceeds from someone who owed the company money. So they collected that along with their account earned some interest. So those are both additions to the bank account that have not yet been recorded on the books. So you add those in. Then you subtract out any deductions that you see on the bank statement that you haven't already recorded on the books. So there was a check printing charge, so that's a bank fee. On the books, they hadn't recorded that yet. And then a non-sufficient funds check, that was a bad check that they're now having to subtract back out of their book balance. So once you do that, you'll notice that you'll get to your adjusted book balance. And again, what needs to match are the adjusted bank balance and the adjusted book balance. This is just another way of looking at it. It's kind of a cheat sheet if you want to do it this way. This one is just in 2 rows instead of columns. So whatever makes more sense to you is perfectly fine for you to use. All right, the next thing we need to discuss are the journal entries to actually record the increases and decreases that haven't yet been entered in the books. So any journal entries you do will only be for items that impact the book balance. So these items will be the additions or subtractions that are already recorded on the bank statement, but have not yet been recorded on the books. So these are journal entries essentially that you would make. Any increases in cash on the bank statement, obviously those are going to be debits to cash, and you will credit whatever account that matches that transaction. So if you're collecting a note, if the bank collects a note on your behalf, you would debit cash to show that increase in cash and credit notes receivable to decrease the amount that you'll be receiving in the future. If the company earns interest on their bank account, debit cash to increase the cash amount, and then credit interest revenue. That's a revenue account. The bank fee for check printing, you can do that a couple ways. You could debit bank fees or bank charge. Here they just record it as a miscellaneous expense. In the real world, I try to avoid using miscellaneous expense as much as possible because it doesn't tell the whole story. It would be more accurate to debit bank service charge or bank fee. And then you credit cash because your cash balance in the bank decreased when they took that money out for the fee. Non-sufficient funds check. Remember on the books, you have already recorded this as an increase in cash. Well, now you find out it's a bad check, so you got to subtract that back out of your cash balance on the books. So that's a credit to cash to decrease that amount. And you debit accounts receivable because now that person, T. Woods, in this example, T. Woods still owes you more money. So you have to increase the amount in their account receivable, and to do that, you debit accounts receivable.